It's not, what we're doing is not rocket science. It's actually quite basic arithmetic, right? It's doing some solid due diligence in terms of understanding the risks we're taking, working hard to understand the extent to which the risks relate to one another, and therefore the risk premiums are genuinely orthogonal and independent. Once you get there, then you let the risk premium harvesting do its work.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Larsen.
For me, the best part of my podcasting journey has been the opportunity to speak to a huge range of extraordinary investors from all around the world. In this series, I have invited one of them, namely Alan Dunn, to host a series of in-depth conversations on the topic of what it takes to be a world-class allocator. In today's world, portfolio construction is fast moving to the top of the agenda of many investors as they try to analyze and understand the riskiness of their portfolios. And with ever-increasing uncertainty around the globe, being well diversified across many different strategies and themes in your portfolio can mean the difference between ruin and survival when the next crisis emerge. The aim of these conversations is to try and understand the experiences that have influenced these highly specialized allocators and the processes they follow to harness the best returns for their clients so that we can all become better informed investors. And with that, please welcome Alan Dunn.
Thanks very much for that introduction, Niels. Today I'm delighted to be joined by Dylan Grice. Dylan is the co-founder of Calderwood Capital. Calderwood Capital is a hedge fund boutique specializing in orthogonal, niche and capacity-constrained hedge fund investing. Dylan has a very interesting background. He's been in the markets for a number of decades. He's possibly best known as the author of the popular Delusions investment newsletter, but his career has spanned being a strategist, a family office allocator, and obviously now as the co-founder of Calderwood Capital. Dylan, great to have you on today. How are you?
I'm great, thanks. Thanks for having me on.
Not at all. Well, I'm sure we've got a lot to get through, but we typically start off by getting a sense of the guest's background. So if you wouldn't mind, for the few people who maybe don't know you and your background, could you give us a sense on how you got into markets and kind of the trajectory of your career that brought you to setting up Calderwood Capital?
Well, I mean, I guess the kind of starting point for me was economics. You know, that was my kind of first passion, really, undergrad and then post-grad. And all I really wanted to do when I was kind of in my early 20s was be an economist, sad as that sounds. And I kind of stumbled into the city. I was a student at the LSE, and everyone at the LSE was applying to all these investment banks. And I didn't know what an investment bank was. I thought a bank was just where you went to, to cash a check or something like that. But I did kind of realize that they seemed to be talking about getting paid quite well. And then I discovered that a lot of these banks employed economists. So I figured that, if I could actually get paid well for studying the economy and doing economic research, then that was better than doing the PhD, which I'd originally planned. So it was a bit of an upgrade on my plans. And, fortuitously enough, I was made a couple of offers. I took one of them. And so that was it. So I started out as an economist, soon realized that predicting markets was more interesting than predicting the economy. Soon also realized that predicting markets was very hard. I went onto the prop desk. I was on the prop desk for about 4 or 5 years, trading equities. and then kind of, did a couple of stints, one back in research, this time as a strategist at SocGen with Albert Edwards. And then when Albert hired me, when James Monty, who had been there before me, James went to go and kind of head up the asset allocation at GMO, and so Albert hired me, and the reason he hired me was because I'd had this kind of 4 to 5 year prop trading experience, and I think that you get, he kind of felt that a lot of sell side strategists would talk a lot, but they'd never really put money to work. They'd never actually managed risk. They'd never managed capital. They'd never felt that pain that you feel when your P&L just blows up in your face and your kind of best laid plans just fall apart. And so, I did that. And one of the things that I got very interested in on the prop desk was really the psychology of trading. I got very interested in the psychology of risk taking, because I observed very quickly there's that it seems to do something to you. When you've got money backing a view, it seems to affect that view. It affects your thinking. And I kind of discovered very early on that risk taking can really make an idiot of you. It can really play with your rationality. And so, how obviously when you to be a successful investor, you have to stay rational. So there was a kind of very, very interesting challenge and internal challenge. How do you stay rational when you've got kind of capital on the line, when you're actually allocating capital, when you're making trades, and the world is just going crazy. And so this was a very interesting kind of psychological problem to solve. And I guess that was my second passion. If economics was my first passion, then I guess this kind of investor psychology was my second. And I've never really left those two. So I went to SocGen. I kind of wrote a bit about that type of thing. James Monty was a well-known behavioural finance guy, so I was kind of following his footsteps really. But I said after a few years, I did get a little bit kind of bored of just writing all the time and not actually managing risk again. And so I was lucky enough to end up at a family office in Switzerland, one of the largest in Europe, actually, multi-billion family office, single family office, where I ended up running about half the assets, helping run half the assets, building the team there, and really just having a great time. Really, really enjoyed it. But I think a few years ago, so this is up to about 2017, 2018, I was ready to kind of do it for myself. I felt that the world was changing, and I'd always had this kind of inkling to set up my own shop and run my own portfolio and try and build my own hedge fund. And so that was 17, 18 was probably the right time to start doing that.
Very good. So, I mean, maybe tell us a little bit about the kind of portfolio you run at Calderwood. Obviously, you mentioned that kind of, I guess, interest, desire for risk-taking, but I'm guessing it's quite different to kind of equity prop trading when you move into hedge fund investing. It's a slightly different pace, I would think, but obviously some similarities, some differences, I guess.
Yeah, I think that the similarities are that you're putting capital to work. You are taking risk. You don't really know what is going to happen tomorrow. You don't know what the future holds, and ultimately, it's a kind of calibration exercise. You're trying to calibrate that uncertainty, and you're trying to kind of size things appropriately. So, in that sense, running a fund of funds, which is what Calderwood is no different from managing an equity book. Another thing which, I guess kind of relatedly, something that all investors do is you're kind of looking at something that's happened in the past and trying to kind of gauge whether or not that's likely to happen in the future. Also, obviously, if something has performed very well, whether it's a stock or a bond or a manager, you're asking yourself, well, is that going to continue? And by the same token, maybe the stock or the bond of the manager hasn't performed well, and you're going to ask, well, is it going to change? Is that going to improve? So you're always asking that kind of fundamental question, and you're trying to answer that question in a world of imperfect knowledge, of very, very imperfect knowledge. So to that extent, that they're very, very similar. I guess the difference is one would be the cadence. So I don't sit kind of staring at Bloomberg screens all day. And that's by design. I don't really enjoy doing that. So I'm quite happy to let other people do that for me. And the second is that there's a kind of unusual return profile with hedge fund investing, and that return profile is that your upside is typically quite capped to the extent that if everything goes well, you'll get what the manager promises they'll deliver. So maybe that's 8% or 10% or whatever it is. That's your kind of upside. The downside is that it blows up, and you can be on the hook for multiples of that on the downside, potentially locked capital, or as backers of FTX are now discovering actually far worse. So there is this kind of negative skew, which is maybe a little bit like a bond portfolio. When you're managing a bond portfolio, a credit portfolio, you have limited upside, you've got all the downside, and actually allocating to hedge funds is kind of similar. So I guess that would be another difference.
And I guess when people think of a fund of hedge funds or a hedge fund investing, I mean, I guess long short equity is probably the biggest sub strategy within the hedge fund world. But I'm assuming you're investing in quite different strategies. You say orthogonal, niche, and capacity constrained. So it's very much outside the plain vanilla by the sounds of it. Is presumably that's by design, that you think there are greater opportunities once you get away from the main strategies, I guess.
Well, that was why we did it. That's why we're here. That was the opportunity that we saw. When I was sitting in the family office, we saw lots of hedge funds. Trust me, everyone was pitching to us, and by and large, they kind of all did the same thing. And it seemed to me that what you were getting, generally speaking, what you were seeing in the hedge fund space was kind of equity in disguise. So long short equity was equity. Event driven was equity. Risk arbitrage was equity. And by equity, structured credit, vanilla structured credit was equity. And what you kind of found, even a lot of quant stuff, it was kind of trend following until there was a market downturn, and then it would get battered when the market was down. Now, quant is actually slightly kind of different for reasons that you know very well. But too much of the hedge fund space was actually just repackaging equity risk with a few kind of bells and whistles and some extra fees, and that was never very interesting to me. One of the things that I also saw when I was at the family office was that there was actually some really, really interesting stuff. There was some really, really interesting firms, some really, really interesting investors doing stuff that seemed to be quite funky superficially. But once you dug into it, actually, it wasn't so funky. So life settlements, for example, you kind of dig into life settlements, and at first, I don't even know what life settlements is. How does that work? How do you price it? How do you value it? What's the market? But once you would dig into it and actually speak to a few managers, speak to a few traders, you would discover that actually there's people in that market who have made their careers in that market. That market has its own culture. It has its own narrative. It has its own kind of folklore. Like stock investors will talk about 1987 or 2008 as the great crash, and they'll be scarred by those experiences. Bond investors used to talk about 1994. They're probably now talking about 2022. And you would find the same thing in life settlements or catastrophe, or more recently cryptocurrencies. And that was just very, very interesting to me. And I think that the opportunity, as I saw it, as we kind of saw it, speaking to my partner about it, was that actually you could you could build a very, very robust portfolio, a very, very solid, sound, low volatility, low correlation, high returning portfolio if you harnessed the full richness and diversity of the hedge fund space. So that's kind of, that was kind of the motivation for what we were doing, right? Nobody needs another equity portfolio which is kind of dressed up as a hedge fund, but is really just an equity book in disguise. And so that's really what we can set about to do. That's what we try and do at Calderwood.
Good stuff. And I'm guessing the macro environment that we've been in, the low rate kind of environment, and, people have been saying for a while, 60-40 is dead or will be dead going forward. And obviously people might reassess that after this year. You can debate that. But was that part of your thinking, that we were at an interesting inflection point? Yeah. It
think that, it was and it still is. The thing about fund of funds, it allows you to be very, very precise about the risks that you're taking. Now, if you're going to restrict yourself as an allocator to long short equity and to some kind of vanilla structured credit, maybe a bit of event driven, then you're really not harnessing the full potential of the hedge fund space, because all you're actually doing, you're playing it safe for sure, and you might throw in a little bit of macro and a little bit of quant to kind of, for a little bit of diversification purposes. But basically what you're going to have is an equity portfolio. And it's just not that interesting. Now, if you've got equity risk, you've got all sorts of things going on. You've obviously got a huge amount of duration risk. You've got your standard kind of equity risk, your equity volatility. You've got your liquidity risk. You're kind of bundling a whole bunch of things together in that one kind of package, which 99% of investors have already. Whereas if you actually say, well, what are we left with if suppose we don't go down that traditional path, if we don't tread that very well-worn path, suppose we actually go a little bit off-piste and see what we can find. You can be incredibly precise about the risks that you're taking. So, for example, maybe we do want to take catastrophe risk, right? Through a reinsurance manager or through cat bonds or something like that. So we're underwriting the risk of a hurricane hitting Florida. Okay, in fact, maybe we want to take that because we're getting paid well for it. Maybe we would want to take longevity risk in the life settlements market. And by the way, I should say that we haven't actually done that yet in the fund for separate reasons. But maybe longevity risk is an interesting risk premium that we can take. Maybe some of the risks that you can take in private credit markets. These are quite kind of interesting. So maybe a little bit of credit risk is also interesting. Maybe a little bit of equity. But maybe duration is something that we really don't want to take. We don't want to take any duration risk. We can do that in our setup because we can be so precise about what we want to do. Whereas if you're stuck on a 60-40, you're just bundling together all sorts of things that you just cannot get out of. And that was something that we really, really, were very clear from the outset that we just weren't interested in doing. And obviously, the way things have gone in 2022, that's been very, very. That's been good. It's been very, very good for our portfolio. We've had no duration, that we've been able to build, a decent portfolio without duration. So that's just one example of I think the kind of advantage you get with a fund of funds.
And obviously, I mentioned at the outset, you're probably best known, or you're at least well known for the Popular Delusions newsletter. And I know your business for a long time was kind of research and investing, but I understand that may be changing. Is that right?
Yeah, well, I mean, when we set up Calderwood a few years ago, I mean, the first thing we did was set up the research business. So we kind of relaunched Popular Delusions. Popular Delusions was the research I wrote at SocGen, and we kind of relaunched that, and that went down well. We also launched the hedge fund business. And when we started it, it was just me and my partner, and that was it. What's happened over the last few years is that both businesses have grown. We're really pleased about where they are. But we kind of were at a crossroads. We had to really choose one or the other because obviously the bigger a business gets, the more attention it demands and the more bandwidth it demands. And we were getting to the stage, really, we had to make a decision. We had the bandwidth for one or the other. And we told our subscribers, we were very, very clear from the very beginning that they were paying for the research, and the research was really about leveraging what we were doing in the fund But the priority was always the fund. You're managing other people's money. You've got a fiduciary responsibility to those people, to those owners of capital. And so we were always very clear that, push comes to shove, we will drop everything to manage the fund. It's not the other way around. And it just got to the stage that we kind of had to, we had to kill one of the businesses. And so the business that we wound down was the research business. Sadly, because it was a lot of fun. We were really pleased with where we'd managed to take it. We had some excellent subscribers, made some very, very good relationships. But you can't do everything. And our focus has always been the fund, and that's now just going to be our full focus from here.
And obviously you have had that kind of, obviously you started off with economics and you've always had that macro view. At the same time, you're taking kind of, getting into the micro quite a bit too, in terms of manager selection and individual strategies. Would you say, is it more top down or bottom up or a mix of both, or how would you describe that?
Well, I mean, probably a mix of both. I think that, one of the kind of foundational experiences for me on the prop desk was this kind of realization that actually I couldn't predict anything very well. And I think that a lot of people might listen to that and say, well, obviously, I mean, everyone knows that. But I don't think they do. I think people typically think that maybe they've got, I mean, obviously it's difficult, but maybe I probably get 51 or 52% of things right, and that's all you need. And I think, no, you don't get 51%, you get 50%, right? And you probably size your positions wrong so that you're actually, on average, you are just going to lose money by taking these punts. And I kind of realized that and saw that, frankly, on the prop desk. So this kind of idea that, the future is fundamentally unpredictable was something that I said, this was a kind of foundational experience. I should say I've definitely met investors who do work hard on predicting, and they are effectively in the business of predicting, and they would be the macro funds and some of the quant funds. But when you speak to the people who are very successful at that, and you see how hard they work at it, it's just not as simple as pulling up a couple of charts that you can get for free off the internet, drawing a few squiggly lines around it, and then thinking that your view has any actual value, because it's just much, much harder than that. I think Richard Feynman used to talk about the advantage he had over most other, most pundits and most social scientists he was particularly talking about. He said the advantage he had, he said, was that he knew how difficult it was to know something, right? This is the guy who actually worked at Los Alamos and did the first experiments on kind of, nuclear reactions. And if he got those wrong, they would know about it. So he knew how hard it was to know something. And I think a lot of people don't fully realize how hard it is to really, really know something. You get into the prediction business, it's really, really hard to accurately and reliably make accurate predictions. And so that's not really something that we do. What we do is kind of the opposite. Our starting point is, look, we can't really predict. We can stress test though. So we can say, well, what if, inflation is running at 10% in 10 years time? Where would interest rate, and how would a portfolio handle that kind of scenario? Can we build a portfolio that actually can accommodate those different stress scenarios and accommodate it well and robustly? So from that perspective, the macro comes in terms of trying to understand the range of outcomes and build in that portfolio robustness to those different outcomes. That's where the macro comes, more from stress testing, not from predicting. And then in terms of the micro, you just get ironically, I think you get much better macro information from the micro, right? If you're actually talking to, you want to have a view on defaults, for example. You want to have a view on the cycle. A great place to start is to speak to a CLO manager, right? Go and speak to a guy who's managed CLO equity. They'll have they still won't really know, but they'll have far more insight into where we are in the default cycle, and more importantly, where the market thinks we are in a default cycle, than any kind of high-level strategist that's sitting looking at the, the S&P data or something like that. So I think we got great insight, I think, into some of what was going on in the crypto markets, because we were invested in cryptocurrency arbitrage managers, right? So we were talking to them regularly. We were having regular kind of dialogue, regular conversations, and we started to, and obviously we were doing our own research at the time and following the market in our own way. And we started to kind of see things that we didn't quite understand, that didn't quite add up, that certainly smelt bad. And speaking to our crypto managers, it just kind of felt that this was actually a market that was not very healthy, and so we pulled it. That's not we didn't predict FTX, by the way. We didn't predict these things, but we could see that this was actually a market that there were a number of red flags. So here you could get a macro view, arguably, but it all comes from much higher quality micro information. I think that the information quality at a micro level is just far higher.
Okay, interesting. And I mean, putting that in the current context, we're obviously in the midst of a tightening cycle. It's the most aggressive we've seen, going back for a number of decades. And we've had this big kind of a rate shock, 0 to, it'll be 4% or so, over 4 probably this week, and possibly going to 5. And everybody's worried, what's going to be the impact of that? Will we see stresses or strains somewhere in the system? Are you picking up any evidence of that kind of from a micro perspective amid all of the different types of strategies and managers you talk to?
Actually not really. I mean, this which is interesting, but in terms of the big short, if you like, we still haven't seen it. We can't really find it. I think that there's, in kind of isolated markets, there's absolutely some big shorts. So I think in Canada, the housing market is an absolute disaster, and I think that is going to be very, very painful for that economy, and probably for its financial system. I think you probably have something similar, although not quite as egregious, in the UK, maybe in some of the Scandi countries. Probably in Australia as well. So I think that I think the housing pain is something which is going to be potentially quite brutal in pockets of the kind of global economy. But I think it's not like in 2008 where it was the US housing market and therefore the entire global financial system. So I don't think that it's necessarily globally systemic, those types of things. Some of the guys we speak to are very, very bearish on the default cycle and where it goes, but some of them aren't so bearish, and it doesn't feel that there's any great. Because I say some of them aren't so bearish. Some of them aren't so bearish relative to where default risk is trading. So you could get. A few weeks ago, you could get double B CLOs, giving you 15%, right? So that can absorb quite a meaningful default cycle. You're unlikely to lose money even in a kind of default cycle, kind of like 2008. So that's kind of telling you that the market's kind of already there, right? I said things have changed over the last few weeks, but yeah, it's beyond that. It's difficult to see. I said we've seen pockets of stress. We've seen stress in the U.S. mortgage market. We saw the agency spread really blow out. We saw pockets of stress in the UK pension market when gilts completely nosedived, yields ballooned, and we've seen stress in the crypto markets, but it just hasn't really been systemic. We haven't seen that systemic thing, and I always, you're kind of wary of saying this, but I think our best guess at the moment is there isn't really a systemic issue.
Interesting. Yeah, I can sense why you'd be wary of. As soon as you say that, you might regret it. But no, I hear what you're saying. Maybe that's been the. I guess that's what we've seen in equity markets as well this year, with the VIX not really ever having that big spike that people had expected.
Well, just because you can't see something doesn't mean it's not there, right? So there's always that kind of that hesitancy to be overly kind of forceful about a conclusion like that. But if you look at, when do you get a big spike in the VIX? The VIX hasn't changed above 40 this year. Now, if somebody told you at the beginning of this year that the market was going to be at its low point 25% down, but the VIX wouldn't have been above 40, you'd probably be quite surprised by that. But actually, obviously you don't have the VIX market, you don't have the VIX index going back to over the last 100 years, but you do have realized volatility. And realized volatility during market drawdowns doesn't always spike to 80 or 100 or 120. In fact, it's actually very, very rare. And the kind of environments, obviously it spiked. I think realized vol hit something like 120 in 1987, right? I think you were in the kind of you were close to the kind of 80, 90 level in 2008. We saw something similar again in 2020 during COVID. But actually, and then in 1929, I think in 1929, you got through 100 on realized volatility. But generally, those kind of spikes are very, very rare. They're very unusual. And the reason is those spikes happen when, correlation spikes. And I know you're a quant, and probably some of your listeners are quants, but that's the equation, right? It's not just the actual volatility of the constituents, it's the correlation of those constituents. And so you get the real vol spikes when you get a correlation event. 87 was a correlation event, 2008 was a correlation event, 2020 was a correlation event. The NASDAQ bust of 2020 wasn't a correlation event, right? Because you had lots of tech stuff that was going under, but you had all the kind of old economy stuff that was recovering, right? And you had all the kind of value stuff that was recovering. The 1970s, so you didn't have a high correlation. Some stuff was going up while other stuff was going down. In the 1970s, it was the same. During inflation, the resource stocks, the gold stocks, the miners, those guys were doing brilliantly, right? So again, you had this kind of, it was almost like it was the 1970s inflation was a kind of redistribution. So you didn't quite get the correlations, you didn't get the volatility spikes. And I feel that this has been something similar, right? We've actually had some people doing really, really well out of the problems of 2022. And so you haven't had that correlation, and so you haven't had the spike in volatility. And I think that people are almost so positioned for it because 2008 is so fresh in the memory and 2020 is so fresh in the memory. But I don't think it's going to happen, partly for that reason. That's one of the reasons why tail funds have generally done so badly this year, even though markets are down so heavily. Most tail funds have been dreadful.
Yeah. I guess, it's one of those questions. Is there something going on that we're not aware of, or is it going to happen with a lag? I mean, if you had gone back to, when the rates cycle started, I think everybody kind of said, rates might go up to 2.25% or 2.5%. That was the previous kind of 2018 cycle. And, you'd see these charts of showing the Fed funds with a downward sloping line showing every progressive Fed funds peak has been lower. It seems surprising that if you told people, no, we'll get to 5% and nothing will break and the equity market will go down and bounce back up, that would have been a surprise, I'm guessing, to people. Has that surprised you?
Yeah, it has been a surprise. I've certainly been surprised by how kind of aggressive the Fed have been. Although, by the way, if you look at this tightening compared to, for example, what Volcker did in the early 80s, it's not that aggressive. Interest rates are below inflation. We've still got negative, real interest rates in that perspective. So I think that's an important qualification. Although, as I said, I have been surprised at his kind of aggressiveness. But I kind of like to think that I don't really care. It doesn't matter.
Yeah.
I actually, we look at some of the kind of opportunities that are sat in front of us, and it doesn't really matter what happens over the next few years. I personally, for what it's worth, I actually think that we're probably through the hump cyclically. There's a structural inflation, the cyclical inflation. I think cyclical we peaked, and I think that the markets will probably do okay, and that risk assets will probably do okay. But that's not a bet that we're interested in making. I don't think that's high quality investment decision making for the reasons I already talked about. And when we look at some of the things that are coming across our desk, you're looking at certainly 15 to 20% returns in some areas. For example, reinsurance. We already talked about reinsurance. Reinsurance, those markets are very hard at the moment. There's a real shortage of capital in those markets, and they've had a tough few years. They had a very tough 2022 because of Hurricane Ian. It was the biggest event and the biggest insurable loss, it looks like, in Florida's history. So there's a shortage of capital at a time when interest rates have gone up. Reinsurance is priced off LIBOR, or whatever they call the benchmark now. So you would have been looking at double-digit returns anyway. But now, given the hardness of the market, given this kind of peculiarity, the idiosyncrasy and the idiosyncratic shock of that market, it's kind of been a perfect storm. So I think that you can be looking at 15 to 20% returns in that space, which you haven't seen for a long time. That's really interesting, and it kind of doesn't matter what happens to inflation. If we're right about inflation or if we're wrong about inflation, we're still looking at, let's call it a 15% return in that space. So, I mean, as I said earlier, I think that it's kind of very interesting to talk about where the economy is going and what might happen to inflation and what the Fed do, but I don't actually, it doesn't really matter to us. We're just seeing some really, really interesting opportunities that are just much more interesting.
Okay. So, I mean, moving into that then, in terms of how you can construct a portfolio, I guess you're trying to access kind of a range of different uncorrelated sources of return. What's the overall objective? Is it, I guess, capital return with capital preservation? Or are you trying to maximize a Sharpe ratio? Or tell us a little bit how you think about kind of building a portfolio and the risk return profile.
Well, I mean, very, very much a product of the kind of family office mentality. A family office typically is about capital preservation. Family offices are, they're typically very, very wealthy individuals, very wealthy principals. They're not necessarily interested in becoming more rich. They just don't want to be poor. So there's a different kind of focal point on the risks that you're taking. Within portfolio construction, you don't necessarily build a low-risk portfolio by only making low-risk investments, right? You can build a very low-risk portfolio by taking very high-risk individual investments, as long as those risks don't correlate. And that's what we do. And so the objective is really to have something which is genuinely all-weather. It's not correlated to mainstream assets. It's not correlated to equities. It's not correlated to bonds. It should be robust to potential regime change. It should be robust to uncertainty, robust to our own ignorance. That's what we try to do. And what kind of return are we expecting to make? Probably, let's say, between 4 and 6% in excess of the whatever risk-free returns are. So right now that puts you into close to double-digit returns that we can make. And by the way, historically that's an equity return, right? Historically, equities have returned something like, just depending on which equity market and which currency, but historically equity markets over the last 150 years have returned about 4 to 6% in excess of the risk-free rate. So what we're effectively doing is we thinking, making equity returns with very, 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 very low volatility and very low correlation, which of course is the holy grail.
Yes, exactly.
That's what everyone's. I think the difference is that we're actually doing it in a very kind of harnessing what Svensson called the only free lunch in finance, which is diversification. It's not what we're doing is not rocket science. It's really not rocket science. It's actually quite basic arithmetic, right? It's doing some solid due diligence in terms of understanding the risks we're taking. Working hard to understand the extent to which the risks relate to one another, and therefore the risk premiums are genuinely orthogonal and independent. And once you get to that, once you get there, then you let the kind of the risk premium harvesting do its work. Yeah,
and I mean, when you get into these kind of more niche, funky, as you call it, strategies, is it more difficult to think about return expectations and the range of outcomes? And are these risk premia more fleeting? Does it require more of a tactical kind of mindset? Like, for example, is that kind of return in catastrophe bonds or reinsurance, does that vary quite dramatically depending on, whether we've just come out of a hurricane or not?
Yes, there's always the opportunity set is always moving. So what might be very, very attractive right now may not have been attractive a couple of years ago, and vice versa. And to give you a kind of indication, what kind of things do we look at? We look at anything, but in terms of our portfolio right now, we do have a lot of quant. We have some arbitrage strategies, whether it's capital structure arbitrage, convertible bond arbitrage. As I said, we had been very active in cryptocurrency arbitrage for a time, but we pulled out of that earlier this year. Which I think is a good example of what you're saying. Sometimes the opportunity set does just shrink. And that can be for one of two ways. It can be because the expected return is declining, or because the expected risk is increasing. What happened in crypto was both. But we also look at stuff like litigation finance, trade finance, mortgage derivatives, correlation trading, volatility relative value. So all of these kind of things are non-trivial. And all of these things require a certain amount of understanding. I should say, my background as family office manager, also as a prop trader. My kind of prop trading was equity and equity products. This is kind of, I suppose, my natural kind of home. I also did some commodity stuff, but I have this macro background. I should say that in our team, my partner Rob is who well, is he spent his whole career in quant, and he's got a PhD in econometrics. Very technical guy. Most recently, he was actually running Rentec's European office for Jim Simon. So he's very well kind of connected, very, very well versed in quantitative strategy. So we feel that we understand that stuff pretty well. And another partner, Tim Bergen, he'd spent the bulk of his career actually running a credit prop book. So he was doing IG, high yield, and convertibles, including convertible bond arbitrage. So he I think between us, we've got the building blocks, right, to really kind of understand. So if you understand equities, understand credit, understand converts, understand quant, you kind of understand, I think you understand pretty much everything. You can apply it to, even if you haven't seen it before, you kind of scratch away the surface and then you realize you kind of have it actually. So credit correlation's not so different from equity volatility, for example, and in many ways. And so, as I said, it's non-trivial, but we feel that we've got we're confident that we can understand what we're doing. And I should also be very clear, if we don't understand it, we don't do it, right? Very, very. It's not like we do everything that's funky. We say no to most things, and quite often, things that come across there just don't make any sense, or the risk profile is just far too high. Risks, the risks that are allocated to a manager are legion, and it's not just about the strategy. It can be about the operational setup, the manager's mentality, how you mark the book, how you cut all these kind of things, which are a little bit kind of unusual.
Interesting. Yeah. I mean, you touch on an important point there of understanding kind of the risks in the strategies and the investments and how they link. And I guess, obviously we're all familiar with kind of correlations going to one, in a crisis, and, kind of familiar with kind of unforeseen consequences. So I guess, how do you kind of navigate that risk? And I guess that's part of the skill of running a portfolio like this, of thinking about, if we have a problem in X, how do you know that it's not going to impact this particular investment that you have? Is that you could probably seduce yourself by saying, well, correlation is low, but as I say, that can change quickly. How do you I suppose deal with that risk of something like something that might be driven by a micro consideration being overwhelmed by a contagion from kind of a macro factor?
I mean, yeah. So I guess that's where it starts to become very, very specific to managing a hedge fund portfolio. Because you, as I said, we can be very, very precise with the kind of risks that we're taking, and therefore we can be very, very precise about how to diversify away from some of those risks. So if you're just allocating financially, if you're managing an equity portfolio, for example, you might kind of have some bank stocks because you think they're very, very cheap, and maybe a hedge against some kind of systemic problem would be some gold mining stocks or something like that. But if there's a huge liquidity event and everything kind of, correlates to one, as you said, then the gold mining stocks are going to go down with the bank stocks. So your kind of your diversification is not really going to be there. Of course, the problem here is that that type of manager is just in one asset class, and one type of instrument, i.e., publicly traded equities. We don't have any of those constraints, so we can actually diversify. So, suppose we find credit risk to be attractive, and let's say we were talking about CLO double Bs, a moment ago. Suppose that's an interesting way to take credit risk. You're getting paid much more in CLO double Bs than you're getting in, say, high yield or investment or something like that. Let's just suppose, for example, that that's what we think that's an interesting risk that we want to take. Of course, we're kind of on the hook for a much bigger default cycle than we think, or a much bigger correlation event. But we can actually allocate to traders and investors who benefit from that correlation. Correlation is actually, implied correlation is a tradable thing in the CDS tranche markets. So, and of course, like anything else, sometimes it makes sense to own correlation and sometimes it doesn't, and sometimes it's cheap and sometimes it's expensive. But typically, not always, but typically what you find is that correlation is cheap when spreads are tight. So we know of managers who trade that correlation and effectively know how to get very, very cheap when the market is offering it. They know how to get very, very cheap convexity to correlation events because they are long correlation. So effectively, they want to have those. So if we've got in our portfolio a manager who's actually going to get hit by a correlation event, but another manager who's going to benefit from a correlation event, then now we're offsetting those risks. And of course, if each of those managers actually has some kind of alpha or underlying it, then over time, what we find is that both managers should be performing, but at any particular time, if one's not performing, the other one should be. And so that's one way that we can manage that risk. Of course, you might then say, yeah, but if there's a really, really big correlation event caused by a financial system meltdown and prime brokers are pulling leverage and the bank's going down, then even your correlation manager is going to be in trouble because he's got counterparty risk with the financial system. And so how do you diversify that? And again, that's now you're getting into the realms of things that are very difficult to diversify away from. But this is where things like private credit can be useful. Private credit is very risky in all sorts of ways. But one of the ways is, if you're structuring transactions where you actually have the bank account and it's a segregated bank account and you're just permissioning people to put money in and disperse it to borrowers, and you're always in control of it, then you're kind of more in control of your counterparty risk and you're more in control of the liquidity profile of your that you're facing. You're not going to get gated. So this is so in terms of the portfolio construction, you can actually do some. You can to some degree you can hedge some of those more hidden risks because you've got a wider range of instruments that you can deploy.
Okay. And I mean, in terms of building that all-weather kind of return profile, do you have some kind of buckets in mind, or are you thinking, okay, this strategy falls more into growth and this is more inflation protection and this is kind of correlation protection, or is it more okay, it's taking a kind of more of a holistic view and making sure you have some protection to all of the scenarios? How do you think about that, all weather in that sense?
That's a great question. I should say that in simple terms, we're value investors, right? So it's not about buying I mean, for example, suppose, for example, you say, well, so you're not going to predict that the market is going to decline, but you stress test. Well, what would happen if the market, just suddenly fell by 30% in a month or a week and volatility spiked? Obviously, that might happen. You don't want to predict it, but it might happen. So, how do we build a robust portfolio against the market falling by 30% in a month? And the answer is you can buy some put options, right? The problem is that's not very good value. That's not a very intelligent way to protect yourself from that tail. We would argue. Sometimes it is, but usually it isn't. Buying puts, I've given you a vanilla example, but you're not really getting good value. So it doesn't really make a lot of sense. So yes, we want to hedge yourself from a very sudden market decline, but we're not just going to go out and spend lots of money on insurance premiums, right? Because that's how you lose money. I think that what we think much more closely about is how can we get good value for that tail? How can we get good value? How can we get a very, very cheap or even a negative cost protection against that type of scenario? Very cheap exposure to that scenario. That's kind of what we do. And that's, as I said, that's not easy. You're talking about cheap or even free insurance, and people don't like to give away cheap or free insurance. People normally charge quite a healthy premium for it. So we spend a lot of time doing that. I give you one good example right now is the SPAC market. SPACs are a really hated area of finance, I think for very, very good reason. Lots of crooks, lots of phonies, lots of bad actors, some terrible companies, and just frankly, some all-around kind of bad behavior. And obviously, the SPAC market's been kind of found out. It kind of peaked, probably would have been about, I think it would have been about February last year, and it's had a very, very tough time since then. Activity's ground to a halt, but what you're left with now, you've left with a market that pretty much everyone has exited, and you've got all these kind of distressed stroke, probably defunct SPACs lying around trading for zero. Now, the interesting thing about SPACs is that you do get, when a SPAC is issued, I don't know how much you know about SPACs, but when a SPAC is issued, it comes with a warrant. Right, and that warrant, which is just an option on the typically 5-year option on the future value of the stock. Now, when a SPAC IPOs, it's a pool of cash, right? So an option on cash isn't worth anything. But if they do a deal and suddenly that cash now becomes a stake in a business, and the business goes well, then obviously that option, that warrant is worth something, right? So what you have with these warrants is you basically have suppose you've got a bull market and suddenly these SPACs are finding lots of deals to do, and these deals actually, some of them are worth something and they actually go up in value, then these warrants are worth something, right? And what you have right now is that these warrants are trading basically for zero. Right. So, and there's very good reasons for that, right? It was specific to the SPAC market. But if you get a return to the bull market, if you get a return to, the kind of go year, or even if you actually just get some kind of life coming back into the market and the market starts moving higher again, those warrants are going to be worth something, right? Now, right now we're getting them for zero. So this is interesting. This is very interesting because now we've got that right tail, right? Suppose there's a runaway bull market in stocks. We can get exposure to that kind of for free with no downside, right? That's a kind of interesting kind of risk profile for us. And of course, you could then even take it more macro and say, well, why would that happen? Well, it might happen if there was a big inflation blow off, right? So suppose actually inflation hasn't been brought under control, and suppose actually the Fed are talking tough because it's easy to talk tough with unemployment at 3.5%. But how tough they're going to be if unemployment hits 8%, right, or 9%, right? And suppose that happens sooner than we think, and suppose the default cycle is worse than we think, and actually suppose they pull off and they stop raising interest rates without really killing inflation, and inflation rips during the next cycle. That could be very, very bullish for equities as a kind of inflation hedge. If we can get exposure to that for free, that's offered very, very cheaply. That's very, very interesting. So, hedging outcomes, it's not just about necessarily hedging market downturns. It's pretty much, all of the angles that we can think of. Can we find a cheap way to get access to that?
Interesting, yeah. I mean, the other, I suppose, skill that's involved in all of this is assessing the manager as well. Obviously, you're a fund of funds investor, so you're handing over the cash to another manager. And you talked about how you've worked with people and been fascinated about the behavioral side of things. Is that, do you think, a different skill manager selection? Is it subject to the same kind of behavioral biases when you select a manager as when you invest in an equity, or different biases? Yeah.
No, I think it's the same. I think honestly, I run an equity book, and I mean, I ran an equity book at the family office. This isn't just my prop trading stuff. So prop trading, it was quite short term. It was a trading desk. Whereas the family office, when I first went there, I went there with the job of building an equity team, and this was a family office approach to investing in equities, which is radically different. It's very, very fundamental, very, very long term, and the opposite end of the spectrum from the prop desk, really. But one of the things that always struck me about the equity market was the power of the narrative. People would always go after the narrative. People love the sexy story, and we just saw it kind of turbocharged in 2021. We, Cathy Wood and the SPAC market we've just been talking about. That kind of narrative, it can seduce you, and it can blind you from and distract you from the things that you should be paying attention to and the things that you should be looking at. And that's absolutely no different with managers. The narrative, managers will try to seduce you with a narrative. They will have their kind of story, as everyone does. And I think that maybe the best heuristic that I came across and deployed and continue to deploy was that you watch the actions. You pay attention to the actions, not the words. What are they doing, right? What do they say they're doing? And that's fine. That's interesting, but it's not the same as what they're doing. Right? Do you actually understand what they're doing? I mean, it's so straightforward. It's such an easy thing to, nobody would disagree with that. It's so uncontroversial. You play with the ball, not the man. But it really is I think it's one of the most common mistakes.
Okay. And I mean, from your own perspective, selecting managers, are there are there kind of criteria you would say, okay, this makes them a great investor or a great manager? Is that just a qualitative assessment, or do you think you can kind of quantify that?
I am very skeptical that's quantifiable. Again, I have a kind of a macro background. I've known a lot of macro investors. I do think that a lot of it is hot air. I think a lot of it, it's we actually don't really invest in macro because it's very, very difficult to determine the extent to which people actually know anything, right? Or they're just guessing, or they're just on a hot run. I think there's a couple of exceptions, but macro is very, very much about the narrative. Lots of people spinning a narrative and buying a narrative in a way that is very difficult to invest in. Our preference really is to invest in managers. I think it's much easier. Invest in managers who just have found this niche that they absolutely are on top of, and they know how it works, and they know how to do it, and they've been doing it for bloody donkeys, and their team have been doing it for donkeys, and that's all they do. Ideally, those types of managers are just harnessing something from the market, whether it's some kind of risk premium that just has to exist, or just some little kind of niche that's just not, it's too small for the big guys to be interested in. Those types of managers are more interesting, I think, because I think that people spend so much time fussing about, alpha and finding the best in the peer group. And of course, you want to find the best in the peer group. You don't want to knowingly associate with the dummies. You don't knowingly want to allocate to the idiots. But to reliably be the best in the group is just very, 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 very hard. I think it's much easier to pay for access. You find someone who's found, who knows how to source litigation claims in the north of England, right? That doesn't mean that they're the best litigation sourcer. It doesn't mean that, right? But you're still going to pay them fees because they're going to make a very high return because it's such an inefficient market, and you don't know how to source those deals, right? You don't know the ecosystem, you don't know the landscape, you don't know you don't know the background, you just don't know how to source. So effectively, what you're paying the manager for is access, and of course, the manager has to have high integrity. Ideally, they're quite smart, but you're not really paying for because this manager is best in class. Right, you're paying just because this manager has access to a return stream that most people don't have access to, and that's the type of the manager that's the type of activity that we like. The type of manager that we like typically is probably not the type of manager that you would necessarily want to have dinner with. Maybe the kind of manager who's so down his rabbit hole and so obsessed with his or her space that they don't really have much else to say. And they don't have much else to talk about. That's the ideal kind of manager. And even better if those types of managers don't have a good sales department, and they're not very good at selling themselves because they're not great dinner companions and they're frankly a little bit geeky about their own area. That's the kind of that's a great kind of manager to invest in. So I should say that a lot of our managers are very, very fun, and they do like to they are very good over dinner. So it's not the case that we only go for people who are not great dinner companions, but that's the kind of that would be the sweet spot for us.
And I mean, briefly, we're getting close to the hour. I mean, when things go wrong and the types of scenarios that prompt you to exit from a manager, does that typically be driven by that maybe that risk premium isn't there, or the expected return isn't as strong, or can it be something more manager specific, or what are typical triggers around that side?
Yeah, I mean, all of the above. I think it can be that the overall market is not looking as attractive, and I said that can be because expected returns are lower, or it could be expected risk is higher. It could be manager specific. The manager has lost their focus for some reason. The manager's AUM has grown very, very rapidly, very, very quickly. And again, that can sometimes rapid AUM growth is kind of okay. It depends on what the space is, and it depends on what they were, what they set out to do. If they set out to say, listen, we actually, we're doing capital structure arbitrage. We think we can allocate, we can deploy $1 billion in this space, and they're a $150 manager. Well, if they suddenly get up to 600 or 700 or 800, that's okay, right? Because that's what they said they were going to do. When you get a private credit manager who's managing $50 and says they think there's maybe 150 of space or capacity, and next thing you know they've gone through 300 and they're looking to get to 500, then I think you kind of ask questions, and of course, I would say it's a combination of those things.
Yeah, no, fair enough. Great. Well, we typically ask people before we wrap up, you've obviously been in the markets a number of decades, done a bunch of different things. For people who want to, develop a career along similar lines, either as a strategist or researcher or a hedge fund allocator, what would be the tips that you would tell people, things to focus on or things to read, etc.?
So firstly, read a lot. You have to read a lot. I think Charlie Munger said he didn't know any successful person who didn't read a lot. And I think that's true. Read a lot and read actively. So don't just read a book and then read another one and then read another one. Take notes on it, absorb it, digest it, find people to talk to about it. And it's not just about books, it's investor letters, it's newspapers, it's whatever you can kind of get your hands on. The second thing is, you can kind of read as much as you like. You won't actually know how to do something until you do it. So go and do it, right? most people will tell you, if you've got an idea or you've got something, most people will tell you it's a bad idea. Most people will tell you that it's stupid. Most people tell you not to do it. If lots of people tell you that, I mean, it might just be that they're right. But if you really, really feel it and you really, really believe it, listen to yourself. Don't let other people dissuade you. If you really, really want to do something, you have to get out there and do it. You will ultimately be better off for the experience. And then the last thing is, you got to love it. You got to really love what you're doing, right? It's got to be what animates you. And you have to be very honest with yourself about what animates you and what you love to do. Because you're competing, and this is true for anything. It doesn't matter whether it's finance or soccer or anything. You will be competing with people who really do love what they're doing. And the people who really love what they're doing, they will put the extra hours in. They'll be the ones who are kind of thinking about it when they should be watching a film with their kids, or, they will be the ones who are kind of, be waking up in the middle of the night, jotting down investment ideas or whatever. That's who you're competing with. So make sure you love it. And if you don't love it, don't do it. Find something that you do love.
Well, great. That is great advice. Appreciate you coming on. It's been fascinating talking to you. So thanks very much, Dylan.
Thanks a lot for having me. I really enjoyed it.
Absolutely. No, with that, thanks. And back to Niels, I should say.
Thank you so much, Alan and Dylan, for some great insights into the thinking of a hedge fund allocator. Dylan made some really great points, one of which, of course, is how difficult it is to know something and why it's better to build portfolios that are really not sensitive to the latest CPI or non-farm payroll figures, or whether or not you can make accurate predictions about the future. Stress testing ideas and building portfolios accordingly seem to have served them well. I also found his observations and experience about how so many of the hedge fund strategies in reality are just different shades of equity risk, something I very much agree with. Of course, his research into how historical realized volatility does not have to always spike during a crisis due to the correlation factor was also very useful to hear for many investors who are looking to protect their portfolios, and how he believes that you can build a low-risk portfolio using higher-risk strategies as long as they don't correlate, something that we, of course, are very much in agreement with on this podcast. But of course, there are so many more gems in this conversation. That's it for this episode. Make sure you go and follow Dylan and Alan's work, because as you can tell from the conversation today, it is so important that you understand what's going on from a global macro point of view in order to allocate capital well. And we really look forward to sharing many more of these insights as our series continue. From Alan and me, thanks so much for listening, and we look forward to being back with you on the next episode. And in the meantime, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.